All right. Well, thanks for being here. Let me set this up. So we've got Jeet, Pete, Adnan from our leadership team. We're doing questions in the hot seat. So I have a list of questions that we've received in the last month. These have come up in early conversations with new clients. We've got a mix of topics between sales, pricing, negotiation, value. Obviously, you three have not seen these questions. So I got these from other members of the leadership team. So we can thank them for these. Couple rules as we go. So of course, no preparation. And how could you? Because you don't know what I'm going to ask. Somebody's got to jump in with an answer within a few seconds so we don't have dead air. And then see if you can keep answers relatively brief, like in under 2 minutes, and avoid saying it depends, which of course we know everything depends, but maybe just commit to an example or
We're
whatever.
Consultants. It's got to be 2 by 2 and it depends. That's
I
the
know.
only way to answer any question.
I know. I'm like, everybody out there, do better. All right.
There are many factors we should consider.
Exactly.
There you go. There you
Just
go.
a 10-minute bit making fun of consultants. Okay. All right. Are you ready for the first question?
Let's do it.
Okay. Before learning to negotiate, we need to learn how to set ourselves up for a good negotiation. What should we be doing earlier in the sales cycle?
That's a good one. Pete?
I'll jump in on this one. So actually, yeah, I don't know who, I can guess who gave this one, but had a couple calls with prospective clients, and I think and clients, and this one's coming up more frequently, where it's not just, you know, help us prepare for this one deal or help us coach through this big renewal. It's lay the foundation so we can build skills, so we don't just, you know, apply it to this one situation, we can apply it to more. And I think part of that, it's actually helpful to think about both sides of our, you know, internal Holden Advisors practices between pricing and sales, because so many of the foundational things that we talk about in pricing are the same foundational things in sales, which is, all right, what does different segments care about? What are the values? So, and by the way, we need to start messaging that value once we understand it to our customers, so that when we have the pricing and negotiation conversation, they already believe it, and there's some added credibility. If you drop in at the last minute and say, hey, there's a price increase, let's have this conversation about our commercial terms for the next year, 2, 3, and they don't realize everything they get from you, then you're kind of late to the party, and you're just setting yourself up for a fight over like a very set size of pie, as opposed to showing them that the pie has been growing over the past months, years from the relationship.
Yeah, I think you had this in your the statement you made, Pete, but a critical piece, just to call it out, is making sure your client or your customer has experienced the value. So if you have time, you know, it's one thing to talk about value, it's one thing to quantify that value and have those conversations as early as possible. Those are all obviously extremely important, but fundamentally, you should really allow that customer to experience the value. Then it just makes it a lot easier to have that conversation. Then it's based on their numbers, it's based on their experience. You're not just out there saying, trust me, it'll work, and this is the benefits you'll get. You know, if they experienced it, then it's based off of their sort of line of thinking, which makes it that much more powerful.
All right, next question.
All right.
We've passed along multiple price increases. How do we know if we will lose customers in the next one?
Oh.
It's always a tough one. We come across it often. Having a strategy around those price increases is key. And, you know, history is history. You can't necessarily change that. And you don't know what is going to happen as a result of the next price increase. But what you can control is how effective and how disciplined you are around that next price increases. Meaning, are you doing all the right things? Are you taking into account with your customer base that they have experienced these past price increases and they may have this anchor point? Are you communicating the value, and do you yourself understand the value you are bringing to the table relative to other options? And then is that coming out in the message via your sales team? So it's a matter, it's in my eyes, it's more a matter of doing all the right things in preparation for that next price increase, and also acknowledging the fact that customers have experienced a past price increase. And then you can start to put your finger on, say, the potential churn that could happen as a result of that next price increases. And in that case, it's a matter of just forecasting in the right way what that potential risk could be and developing a comfort level around the financial benefit that this price increase can get you versus the risk that you are incurring. So it's hard to predict what's going to happen, but I think there are a lot of best practices that you can put in place to mitigate the risk and estimate what that risk is going to be.
I was going to say, yeah, and on totally. And you could look, past performance doesn't guarantee future performance, but you can see, when we had price increases recently or years ago, whatever it was, did we have churn? What were the segments that had that? So there's a little bit of a guide where you could say we had this much additional churn when we changed prices. That would be one way to do it. The other way, not the other way, but the way to mitigate churn, even if you expect some, is to make sure you communicate it correctly. Like you're not just doing a blanket price increase. It's a little bit more strategic and targeted. You communicate it effectively, and then think internally, get your ducks in a row to have an action plan about, okay, well, what are the options we're going to provide someone who can't pay it? Do we have a lower tier thing to keep them in our four walls? Do we have like the waterfall of messaging so that, we're going to triage the customers who, yell about it or have a problem? Because some of them will probably just accept it and realize that they're getting a great service from you already.
Just to add to what the guys have said, obviously, there's no sugarcoating. If you're going to raise prices, there's a risk of churn. You're not going to, there's no guarantee that you'll never lose customers. You can lose customers for so many different reasons. And an incremental price increase could be the hair on the camel's back kind of thing, right? That it's just, it could be the trigger that they were waiting for because of other issues. So who knows what it is? But regardless, there's always a risk of churn. If you're pricing within that differential value and you're splitting that value with your customer, the likelihood is less. If you're up in the top range of that capture rate and you're not sharing the value as much, then you have a higher risk, right? That's the theory behind it. I will tell you, if you have a good split of value, differential value between your customer and yourself, rarely do we see customers leave, what Pete was just talking about, right? But if they are leaving, they tend to be the price buyers that are leaving. And then guess what happens with price buyers? You can always get them back by lowering your price. So in the future, if you want them back, you can just lower your price and go get them back. So I think, you have to be cognizant of the type of people you're losing, as long as you're staying true to the theory of, hey, this is a fair price and we're splitting the value here and we believe in the value. Then I think it mitigates a lot of risk. To Pete's point about the communication of it, that really mitigates a lot of risk there. Oh, sorry. One more point. I love this stuff, so I have to monopolize this time. But the other thing that we've noticed is how frequently you do a price change. So regardless of the split of the value, we've noticed that if this is your third price increase in a really short period of time, the price sensitivity of that customer goes up exponentially. So you really are affecting that sensitivity. Even if you're fairly distributing that incremental value, you're hitting them too hard where they start looking for alternatives. And that's one thing to really avoid is if this is your third price increase in a short period of time, and I'm on purpose saying short because different industries, it could mean 6 months, 12 months, 18 months, whatever the number is. It's really dependent on the industry. But if you're doing that the third time, then these customers tend to act like consumers in that way, where they start feeling like they're getting taken advantage of and their sensitivity goes up and they're willing to sometimes change to other providers and even take less value. We definitely see that.
I think it could also, I think that, gee, that's particularly true if you think about if your company has a profit maximization goal and you're sticking with that pricing strategy, then those price changes have an outsized effect on it, where maybe you're going from a market share maximization or revenue maximization and you're thinking we need to have more profitable growth rather than just market share. You might expect to lose some customers, and that you've done that break-even math to say it's worth it and part of our strategy.
That's right. That's right.
All right.
That was a good question, by the way. We get that a lot. That's a
Yeah.
fun one.
Okay. All right. Next up, we believe that our level of quality and service differentiates us from the competition, but the sales team continues to tell us it is all about price. How do we find out what is really happening?
I think there's a pretty straightforward answer in my eyes. Go talk to your customers. So there's not, if there's a question and you're getting different messages from, say, market analysis versus sales team, go talk to customers, go talk to prospects, have those one-on-one, perhaps tough conversations to get a real sense of why it is that customers value. And in our experience, having conducted 100+ customer conversations, if you're engaging them and asking them in the right way, they'll be more than happy to share with you what's really going on. After you have 1, 2, 3 of these conversations, you start to build up from there, and then you can start to identify themes and get to the heart of what is happening, develop some hypotheses, and then test these hypotheses out. In our experience, right, there's no better voice for determining what's truly happening in the market than talking directly to those folks that are making the purchase.
Could not agree more. And I think the other thing, I think if you looked at the Salesforce instance and which members of a buying center the sales team is talking to, you might see 1 or 2 people listed on that account. And the question has to become, all right, well, who are those people? If they're in procurement, you're missing out on probably a whole host of other users in the company that care about your product versus the person that's positioning for the negotiation. And just for a data point, from 2016 to last year, the number of members in the buying center went from 6 to over 11. So you basically almost have a doubling of the number of people that you need to interact with that are making a decision and influencing whether they buy from you. So if you're talking to the wrong person, they're going to tell you you're commoditized and not differentiated all day long. And so it's your mission not to believe it if you think it's not representative of everyone in the company.
And Pete, I love these numbers that you always talk about, which is, if we're training sales organizations and we ask, how who thinks their portfolio of customers are mostly price buyers, most salespeople raise their hands and they go, yeah, my portfolio is mostly price. And in reality, Pete, what's the number of amount of price buyers we see in the market? True price.
It varies a little bit by industry, but 10 to 20%. So it's a small slice, and then that means that those value and relationship buyers are kind of posturing as price buyers. We call those poker players. So they're kind of pretending.
Yeah, that's right. And then, my other thing that I always like to say to folks that talk like that is if theoretically, if truly you're in a commodity and there are 4 players in the market share should be 25, 25, 25, 25. Like truly, that's how it should be, right? And rarely are we ever in a market space where it's split like that. Therefore, there's something you're doing that's creating incremental value for your customer that's allowing them to stay with you. So you have to find out, like Adnan correctly pointed out, which is go talk to your customers to find out what that is. And you can price on it. You can price for it because you can harvest those dollars because you're creating value for your customers. So I think it's very rare that you're in a commodity. It's very rare that you're only speaking to price buyers. And you should really look at yourself in the mirror and get out there and understand how you're creating that value.
All right. Next up, we create our selling advantage on price through scale. How do we better uncover and articulate our differentiation?
Repeat the question again.
We create our selling advantage on price through scale. How do we better uncover and articulate our differentiation?
I hear that as like a cost leadership competitive strategy, basically. So maybe for some companies that have that, and then I think, ultimately, like think of the Amazons of the world, and now they're obviously leveraging more on their pricing power, but for a while it was the lowest cost way to get online goods and free shipping, everything else. So I guess the question is, how do they differentiate? If they sell on that, can they move into more of a focus? Or so basically there's 2 different ways. It's either cost leadership or you're kind of differentiating with value, and I think you need to pick one. You can't do both, is I guess my short read on that question is like if you're trying to shift your perception in the market, that could be tough. Or maybe launching products that are higher value and not just a, you know, a price competitive, low quality offering is one way to think about testing the waters there.
I don't even understand the question, so I'm gonna just say.
Jeet rejects the question altogether.
I understand.
I mean, I feel like that's a really tough game to play in that Amazon example that that Pete gave, because if your strategy is, hey, we're gonna develop a cost advantage over time as a result of getting scale, you know, getting back to Jeet's point earlier, where if you have 4 different companies in that space and they have a similar strategy and they're trying to get scale, then, you know, you're at risk of causing a price war unless you're willing to, you know, deeply discount price, perhaps be unprofitable for a pretty significant amount of time, and then grab the right market share to get scale. But it doesn't seem to be a very sustainable strategy, and, you know, adds a massive amount of risk into the business.
Basically, go after, going after the whole market is setting yourself up for needing to be the lowest cost provider across everybody. You should go after the customers that are best fit for you, that align, that care about the things you do.
All right. Next question. What is stale pricing?
I love this one.
What is stale pricing? How do we know when our prices are stale?
Tracy, I know where that question came from.
Dale donuts.
That's right.
I'll reveal my sources for my procurement questions.
You know, I think we as a pricing industry, we think of pricing as sort of a one-time event of doing an exercise, and I think we do ourselves a little bit of a disservice there, because our markets are changing, right? Supply demand changes. Competitors are changing because they're releasing new versions of products and solutions and new services. Everything is dynamic in nature and everything is changing. So if you think about a value-based pricing approach where you're looking at your competitor, you're looking at the differential value, you're quantifying it, and you're pricing within that differential value, if the market is always changing and you're not monitoring that market, you're not monitoring those changes to know how it affects your price, then your price is probably stale. You know, if you're not monitoring it and making sure that you're still in that zone of differentiation and you're using those value conversations in your product development, your customer service, your sales, and you really understand and you have your finger on the pulse of customer needs and value, and then you're also monitoring your competition to make sure that you're learning on what they're releasing, how they're addressing market needs. If you're not doing that, then likely your pricing is stale.
I've also seen just, you know, some relatively quick analyses that you can do to get a sense of whether or not your pricing is stale or out of date. If you were to go and look at, say, a price to volume type of analysis, and you see similar deals that have, you know, significantly disparate pricing, then you likely need to go in and relook at what your pricing for your existing base is. If you go in and do a churn analysis, and for example, you're on either end of the spectrum where our customers never leave, or, you know, we're getting massive amounts of churn and customers are leaving very regularly, either side of those things, your pricing you probably need to relook at some of your pricing.
All right, that's it for today. I have probably equal, if not more, questions for the next one. So let's do a round 2. And thank you for this.
Good.
Awesome.
Good.
All right, guys, thanks.
Thanks.